Good afternoon, all of you. Today we are going to touch upon a very critical topic in finance management, that is the capital structure theories. As you all can remember, we have touched upon mostly the theoretical part of the subject in our previous session. So this capital structure theory, we are going to touch upon some of the few practical aspects of this particular theorem. So let us understand what does we mean by the capital structure. As the word suggests, capital structure means the composition of the various sources of finance like equity shares, preference shares, debentures, bank loans. So all these constitute a capital structure of the organization. If an organization is sourcing the finance through equity shares, or they are borrowing loan from the bank, that is a debt instrument, or they are issuing debentures, or they are issuing preference shares. So these composition or this structure of the financing organization is known as the capital structure. So all these sources of finance, as you all know, are appearing in the liability side of the balance sheet. The share capital, the preference shares, the long-term loan which the organization obtained from the bank. So all this composition which is appearing in the liability side of the balance sheet is termed as a capital structure. So we'll understand the concept of this capital structure. So concept of capital structure is the proportion of all types of capital, equity, debts and preference. It's a simple definition, is the proportion of all type of capital, this is equity, debt and preference. A company is having a composition of many sources of finance. It can finance its investments through shares, through debentures, through preference shares, through long-term loan. So all this composition in the organization, these sources of finance, this composition of the capital structure is known as the capital structure. It is a synonymous used in financial leverage or financial mix. This capital structure is also known as the financial leverage or the financial mix. Why it is a financial leverage? Because it decides on the composition of finance which you are going to source from the equity shares or from debentures or from the loan. That's why it's called a leverage. Leverage means how you are going to source your investments. Are you going to buy more of loan from the banks, or you are going to issue more of equity shares? So all these compositions will be known as a financial leverage, or it is known as a financial mix. So the term capital structure refers to the relationship between the various long-term sources of financing such as equity shares, preference shares and debt capital. So it is a composition of the three sources of finance. Financial leverage is the extent to which a business firm employs borrowed money or debt. So financial leverage is the extent to which a business firm employ borrowed money or debt. How you are going to leverage? Leverage means how you are going to source your investment in the organization. Either it will be through a borrowed capital, or it will be through a preference shares, or it will be through debentures, or through equity shares capital. So what leverage you are going to take up for financing your investment, so that will be known as a financial leverage. So financial leverage is another name is capital structure. Both are meaning the same thing. So in finance management, it is a significant term and an important decision in a business. Why it is important? Because for debentures or for loan, you are going to pay interest to the bank. So that is a very key element. For preference shares, you are going to pay the dividend. Equity shares, you have to pay the dividend, but may not be necessary because preference shareholders are on a top priority. When a company earns profit, you have to pay dividends to the preference shareholder first. Then the remaining amount, if it is there, you are going to pay to the equity shareholders. And also, if you have borrowed the loan from the bank, you are going to pay interest to the bank, and you have to pay the amount on the maturity period. So that's why this is a very key financial decisions for the organization. How much you are going to have loan, how much you are going to have through your funds through preference shares, how much you are going to have funds through debentures, how much you are going to have funds through equity shares. So a lot of factors are there. So it depends upon the rate of interest, the returns which you are going to pay, the cost involved, the benefit you are going to have. So all these factors are reckoned while deciding on the capital structure. That's why it is very significant term and important decisions in the business. In the capital structure of a company, broadly, there are mainly two types of capital, as we all know. There are equity shares capital and there are debt. Debt means loan from the banks. There are borrowed fund from the banks. That's why it is called debt. There is equity and the debt. Out of the two, debt is considered a cheaper source of finance because the interest payments are a tax deductible expenses. This is a very important statement. Why debt finance is considered as a cheaper source of finance? Because you are going to pay the interest to the bank. Now this interest will going to appear in the profit and loss account in the debit side of the balance sheet. So it is going to have a tax benefit because you are showing this as an expenses. Since you are going to show is an expenses, your tax liability will be after reducing the profit from these expenses. These expenses is going to reduce from the profit. Hence, you have to pay less of tax. That's why it is called as a tax deductible expenses. It is very important statement. That's why it is called as a cheaper source of finance. The question is, what should be the ratio of debt and equity? This is a very critical question which every organizations are actually struggling to find out what will be the ideal source of finance for the organization. Whether they should go for borrowed fund from the bank, or they should go from the equity share capital by issuing shares to the public. So each and every source of finance has a merits and a demerits. That composition is to be decided by the organization after considering the merits and demerits of both the equity and the debt capital. So we should know the objective of doing the capital structuring. The whole concept of capital structuring revolves around how much to source from debt, how much to source from equity capital. The object of any financial decision is to maximize the shareholders' wealth or increase the value of the firm. Whatever the strategy you are going to adopt, either you are going to adopt debt or you are going to adopt equity, the whole object of the organization is to maximize the profit for the organization, to maximize the revenue for the organization, to maximize the shareholders' wealth. Shareholders has given you the money, they are expecting a reasonable return from the organization. So your objective as a finance manager is to ensure that our shareholders' wealth also should increase along with your profit. So it has to serve, any capital structuring decision has to serve the two purposes. One, it has to increase the value of the firm, the profitability of the firm should increase, your company should not be in the loss because of this improper structuring, and at the same time you have to ensure the shareholders' wealth also increase because they have invested their money into your organization. You have issued the share to them. So once you are in the profit mode, you have to pay the dividend to the shareholders. So whether a change in the financial mix would have any impact on the value of the firm or not? This is the most critical questions which every finance manager should ask. If we are going to change the capital structuring, if I am having a debt, if I am reducing the debt, I am going for equity share capital, or if I am having equity share capital now, I am going more from a borrowed fund. Does is going to have an impact on the capital structuring? Does is going to impact on the value of the firm? That is what we are going to discuss in this total module. One thing is sure, that wherever and whatever way one sources the finance from, it cannot change the operating income level. Operating income, you mean to say, is the income which is before your interest, tax and dividend and all. So the operating income will be the total gross profit less of administration expenses. That is the operating income. So it has nothing to do with your, because interest, taxes and all comes after you are arriving at a operating income. So one thing we should make things very clear, that any restructuring, either going for debt or equity, is not going to affect your operating income. Operating income means gross profit less of administration expenses, but before interest, taxes, dividend and all. So once you reduce these interest, dividend, taxes from the operating income, it becomes a net profit. Okay, so anyhow, these interest, taxes and dividend is not going to affect the operating income of the enterprise. Financial leverage can at max have impact on the net income or the earning per share. Net income, as I told you, net profit less of total expenses including taxes, interest, dividend will be your net income. So once you reduce these expenses, interest, taxes and dividend, of course your net income will going to reduce from the operating income. So from the operating income, if you reduce taxes, interest and dividend, it is going to have a net income. So of course, this financial leverage at the maximum can have impact on the net income, but is not going to affect your gross operating income or earning per share. Earning per share means total earning or total profit of the organization divided by number of shares. Just remember, earning per share is total profit after reducing your interest, taxes, dividend, whatever the amount is left, you divide it by number of shares will be earning per share. Changing the financial mix means changing the level of debts, and change in the level of debt can impact the interest payable by that firm. Yes, you are having a certain amount of debt. The moment you are going to change the debt structure, suppose you are having a 1 lakh rupees loan. If you are going to have 2 lakh rupees loan, that means you have increased your borrowing by another 1 lakh. You are going to pay interest on additional 1 lakh rupees. So it is going to change your interest structure, the outflow, because since you have borrowed the more fund, you have to pay the more interest to the bank. So that's why it is written, changing the financial mix means changing the level of debt. From 1 lakh debt structure, now it has become 2 lakh. Your debt position has increased. You have to pay now more to the bank because you have borrowed more 1 lakh rupees additional, and you have to pay additional interest also on that 1 lakh rupees. And change in the level of debt can impact the interest payable by the firm. Earlier you used to pay interest on 1 lakh rupees. Now you have borrowed another 1 lakh, which has become 2 lakh. Now on that additional 1 lakh borrowing, you have to pay additional interest. So it is going to have an impact on interest. Decrease in interest would mean increase in the net income. Yes, the moment, as we all know, interest on bank on loan, interest on bank loan appears on the debit side of the profit and loss account. The moment the interest amount has increased because you have borrowed more loan from the bank, it will, what happen? It will create an impact on the profit. The moment the interest amount is increasing to that extent, your interest profit will come down. The moment if you decrease your interest level, your profit will increase. Decrease in interest. From 1 lakh loan, you have now paid off 50,000 rupees loan. Now the balance amount of loan is 50,000. Now you are going to pay the less interest on that 50,000 only. Now on that 50,000 interest, since now interest has come down, earlier you used to pay interest on 1 lakh rupees. Now you are going to pay interest on 50,000 rupees. Since the interest has come down on the bank loan, your profit will increase. Decrease in interest would increase in the net income and thereby the earning per share. And it is general belief that the increase in earning per share leads to increase in the value of the firm. The more profit we are having in the organization, the more will be the value of the firm. So increase in the earning per share means to increase the value of the firm. So we'll go to the concept of value of the firm in more detail in subsequent slides. So financial leverage is a useful tool to increase the value, but at the same time nothing comes without a cost. So financial leverage is what the whole objective of financial leverage is to maximize the shareholders' wealth and at the same time to increase the value of the organization. These are the two most fundamental objectives of any capital structuring decision. That is one most important thing, is to have a shareholders' wealth should increase, and at the same time we should have the value of the firm also should increase. But it comes with a cost. What is that cost? Financial leverage increases the risk of bankruptcy. If you are not in a position to pay the loan to the banks, what will happen? You may result into a bankrupt situation. So that is the risk which you are going to carry when you are restructuring your capital structure. When you are going for a huge amount of debt, huge amount of loans from the bank, that is the risk which we are carrying, because you have to pay the amount. You have an agreement with the bank. After 5 years, after 10 years, after 15 years, you are going to repay all the principal amount you have taken as loan from the bank. So these amount you have to be repay back to the bank. So there is an element of risk is available. It is because higher the level of debt, higher would be the fixed obligation to honor the interest payment to the debt providers. The more loan you have taken, the more commitment you have to take to repay those loan amount along with the interest. So you are carrying a very high risk if you are going for a very higher loan amount or going for a very high debt structure. Discussion of financial leverage has an obvious objective of finding an optimal capital structure leading to maximization of value of the firm. So the whole aspect of capital structuring decision is to maximize the value of the firm. So we are going to have a detailed discussion on how we are going to maximize the value of the firm after considering the capital restructuring decisions. So important considerations for planning capital structure. These are the few of the terminologies we should understand before going understand the detailed aspect of how we are going to structure our capital. Return. Return means ability to generate maximum return to the shareholders. That is maximize earning per share and the market price per share. So return means maximum profitability in the organization, which will ensure that your shareholders' wealth is going to increase and ultimately is going to increase the value of the firm. If you are going to have a more profitability in the organization, what will happen? It will increase the shareholder wealth because you are going to declare the dividend. So once you are going to declare dividend means the shareholders' wealth is going to increase. So it ensures that maximum EPS, that is earning per share, and the market price per share. If you are declaring the dividend, your market price certainly is going to increase in the market, and hence it is going to impact on the value of the firm. Your value of the firm certainly is going to increase because your firm has earned profitability, because you are going to declare dividend on those profit income. Cost. Minimize the cost of capital. That another aspect which you have to consider. You are going to buy loan, you are going to issue dividend, you are going to issue interest on debentures. So all this composition of sources of finance are involving some cost. For dividend, you are going to pay the dividend to the shareholders, that is a cost to your organization. You are going to pay interest to the bank loan, that is the cost to the organization. You are going to pay the interest on debentures, that is going to have a cost on the organization. So these costs minimize the cost of capital. The whole object of capital structuring is to have a minimum cost, that is called a weighted average cost of capital. So weighted average cost of capital is all the composition of the total sources of finance, be it debt, be it equity, be it preferential capital. So all this composition, we arrive at a weighted average to arrive at a minimum cost of capital. If the company is having 3-4 sources of finance, debt, equity, preference, dividend, then the company generally finance manager, what they do, they compute the weighted average cost of capital. From all these 4 sources of finance, what is the cost of capital? How much dividend I am going to pay? How much interest on loan I am going to pay? How much interest on debenture I am going to pay? So these are the costs for the organization. So any finance manager will compute the cost of capital. So debt is cheaper than equity due to tax shield on interest and no benefits on dividend. Debt is considered cheaper, as I have already told you, because it is a tax deductible income. It is appearing in the profit and loss account in debit side of the balance sheet, which is reduced from your net income. After reducing these expenses, because this interest on loan is actually expense of the organization, so it is reduced from the profit to arrive at a tax. So that's why debt is considered cheaper than equity, because dividend is given after tax is reduced from the profit. What will be the residual amount, then only the dividend is distributed. So equity, so dividend, so the debt instrument is always the cheaper than the equity. Risk, insolvency risk associated with the high debt component. If you have taken a very huge amount of loan from the bank, there is a risk associated with it. You have to pay the amount to the bank on a stipulated period along with the interest. So if you are not going to pay, there is a risk of insolvency in the organization. Control, avoid dilution of management control, hence debt preferred to new equity shares. Yes, what we call as a control. Control means if you are insisting for the equity shares, if your whole finance structure, if your whole capital structure is based on equity share capital, that means shareholders are the owner of the organization. So it is a shareholder who are going to manage the affairs of the organization. Though management representatives are there, but the board of directors who are representing the shareholders will going to dictate their terms and conditions for the functioning of the enterprise, which any management would not like to have interference into their day-to-day operations. That's why the company, while structuring the capital, ensure that they insist more on debt, because the more you insist on debt, the advantage is that management is having full control on the operations. Shareholders are less involved in their day-to-day functions or operations of the organization. That's why avoid dilution of management control. So the structuring should be such that we should obtain maximum or more of loan from the bank and less of equity shares in the preference shareholder. Flexible, altering capital structure without much cost and delay to raise fund whenever required. The capital structuring has to be made out in such a way you should be able to switch from one fund to another, from one source of finance to another within a quick time to avoid any loss or any future rise of interest or any other uncertainty which may come across in the future. So flexibility, when we talk about, means at any point of time you should be flexible to move from one fund to another without much of time and loss. Capacity, ability to generate profit to pay interest and capital. The whole object of any organization is to maximize the profit. So that's why the company should always be in a position to generate maximum revenue in the organization, to generate maximum profit in the organization, so that they should be ready to pay the interest out of the profit. They should be ready to pay dividend to the shareholders. So there should be self-sufficient money, or the revenue should be generated in the organization, so that to pay interest and the principal amount. Principal means the loan which you have taken from the bank, you are going to pay that amount on the date of maturity. So this principal and the interest you have to pay to the bank. That's why this capacity is very important. So assumption in capital structure story. So when we are going to detail aspects, some of the assumptions we have to consider while arriving at the various approaches. There are a couple of approaches are there, very key approaches are there to define the capital structure of the organization. But before we go to that theories or before we go to that approach of capital structure, we need to understand some few assumptions based on which this theory has been based. There are no corporate taxes. This assumption is removed later. There are no corporate tax. The tax, we are not going to incur any tax. But this assumption is removed later. That means tax element again was brought into the theory. The dividend payout ratio is 100%. That is, the total earning are paid out as dividend to shareholders and there are no retained earning. There are no reserves in the organization. Whatever the profits you have earned, you are distributed by way of dividend to entire shareholders. So this is the assumption of the theory. There are no retained earning. Retained earning is after distributing the dividend, if you have left some amount, it is known as retained earning, which is appear as a liability side of the balance sheet. But in this theory, they are assuming that there are no retained earning. Whatever profit has been earned by the organization is distributed by way of dividend to all the shareholders. The total assets are given and do not change. The investment decisions are, in other words, assumed to be constant. Whatever the structuring has been done, that means you have already decided that so much of debt you are going to buy for this assets, so much of debentures, the fund which you have received on issue of debenture, you are going to utilize for this assets, this amount of equity shares capital you are going to issue for this. So already it has been pre-planned. Your sources of finance you have already fixed for what type of investment you are going to do. So that has been fixed. They are not going to change over a period of time. So that is why it is written the investment decisions are in other words assumed to be constant. The total financing remains constant. The firm can change its degree of leverage, capital structure, either by selling shares and use the proceeds to retire debenture or by raising more debt and reduce the equity capital. The total financing remains the constant. That means if you are having suppose 5 crores, 1 crore for equity shares, 2 crore for preference shares and 3 crore for 2 crore for debenture. So 1 crore equity shares, 2 crore preference shares, 2 crore for debenture. So total 5 crore. So in between these 5 crores you can play around. You can redeem debentures, you can receive the money, okay, you can pay off loan, whatever you want to do restructuring within this 5 crore only you have to do. That means you are not going for any fresh issue. It is written that either by selling shares and issue the proceeds to retire debenture or by raising more debt and reduce the equity capital. So whatever you are doing, the total financing remains the constant. It has to be play around that 5 crore only. The operating profit are not expected to grow. The EBIT is earning before interest and tax. Earning before interest and tax are not expected to grow. So whatever the firm for a particular period has earned the profit, that is EBIT, it is going to remain the same. All investors are assumed to have the same subjective probability distribution of future expected EBIT for a given firm. That means every investor is having some expectation from the organization to have some profit. So that expectation or the probability of expectation of dividend from the organization will remain the same. Business risk is constant over time as they assume to be independent of its financial structure and financial risk. There could be a lot of business risk in the organization. There are internal environment factors, there are external environment factors, there are economic conditions, there are political conditions. So many environmental factors are there which is influencing the decisions of the organization. But for the computation of this capital structure theory, we have assumed that all this business risk is constant, is not going to impact the organization in a very significant way. Perpetual life of the firm. The business is going to run for perpetual. It's not like that it's going to stop for another 2 years, after 3 years or 5 years, the business is going to close down. No. The whole capital structure theory is based on one assumption that perpetual life of the firm. The firm will continue to operate for years long. So classification of capital structure. This is a very simple how the organizations go for defining the capital structure in their total financial basket. If you see, either it can be an equity share only. The company is totally relying on equity shares. They are not taking any loan from bank. They are not issuing any debentures. They are not going for preference shares. They are exclusively relying on equity share capital. Then there can be a combination of equity shares and preference shares. There can be two modes of finance. They can issue equity shares and they can issue the preference shares. As we all know difference between equity share and preference shares, once the company has earned the profit, first priority for the organization is to pay dividend to the preference shareholders. So after paying to the preference shareholders, whatever the amount is left as dividend will be distributed to the equity shareholders. But the problem is equity shareholders have a voting rights, preference shareholders does not have the voting rights in the organization. Then there can be combination of equity shares and debentures. Debentures is again a debt instrument where you have to pay a stipulated interest after a certain period of time. It is a committed, so you have to pay. So you have to go for either equity shares or debentures, or the fourth option will be there can be equity shares, there can be preference shares and there can be debentures. All these three combinations also can be there in the capital structure. Debenture is a debt, equity and preference shares are the equity share part of the capital structure. Now let us understand by way of one practical example, calculation of earning per share in all these situations. So let us understand how the value of the firm is going to increase. When we are talking of value of the firm means the earning per share of the organization. So how to calculate the earning per share of the organization and how the capital structure define or it works out the value of the firm. we'll consider three scenarios. Suppose an organization in situation 1 is having a total capital of 50 lakhs. When we talk of total capital of 50 lakhs means they are having only equity shares. As we have understood from our earlier slides, the company is relying only on equity shares. There are no debentures, there are no loan. Whatever the sources of finance the company is having in the organization is only equity shares. So situation 1 is only equity shares, 50 lakh shares. With 50 lakh share means 5 lakh shares, each share is having 10 rupees. So 5 lakh multiplied by 10 is 50 lakhs worth of shares. The company is financed through equity share capital. Debt is nil. The company does not rely on debt. Tax rate is 30%. Interest on debt, since debt is nil, there cannot be any interest on debt. That's why it is not applicable. And earning before interest and tax, that is the income. Earning before interest and tax is 7 lakhs rupees. This is scenario 1. Now let us move to scenario 2. Scenario 2, again total capital is 50 lakhs. Now 50 lakhs is break up into two parts. One is 40 lakhs in equity share and debt is 10 lakhs. So 40 plus 10 is 50 lakhs. Again in 40 lakhs the company is having a 4 lakh shares of rupees 10 each, that constitute 40 lakhs, and 10 lakh is having a debt. That means either debenture or loan from the bank, they have taken 10 lakhs. This is scenario 2. Tax rate will remain the same, 30%. Now interest on debt will be 10%. That means we have to pay on this 10 lakhs debt instrument, 10% I have to pay, because that is the interest on debt, and profit will remain the same, that is EBIT, that is earning before interest and tax, will going to have 7 lakhs. Now let us understand situation 3. Situation 3, the total capital will be 50 lakhs only. Equity capital will be 30 lakhs. That is 3 lakhs shares at the rate of 10 each. Now you have increased the debt from 10 lakhs to 20 lakhs. The 10 lakhs additional debt you have increased. So tax rate will be 30%. Interest on debt 10%, earning before taxes 7 lakhs. Now for this whole situation, all these three situations, we are going to work on earning per share. That means what was the total earning divided by number of equity shares, which will indicate the value of the firm. So let us consider situation 1. Situation 1 is only 50 lakhs rupees capital, that is through equity share capital. Now situation 1. Let us focus on situation 1. Earning before interest and tax was 7 lakhs rupees. Interest is not applicable, that's why it is nil. We have to reduce tax because this 7 lakh is earning before interest and tax. Now we have to calculate the tax, earning after tax, that is EAT. This is EBIT, earning before interest and tax. Now from this earning before interest and tax, we have to calculate the tax at the rate of 30%. That is 7 lakh into 30% will get 2,10,000. So after reducing tax of 2,10,000, we have EAT, that is earning after tax, is 4,90,000. Now this 4,90,000 I am going to divide by number of shares. Number of shares in situation was 5 lakhs. 50 lakhs was share capital divided by 10 rupees, because each share is having 10 rupees. So 50 lakhs divided by 10 is 5 lakhs. So the earning per share is 0.98. So per share the profit element or the earning of the organization is 0.98. It's very clear. Now let us go to situation 2. In situation 2, as we all know, from 5 lakh number of shares, it has come down to 4 lakh. They have reduced the share capital, but they have gone for the debt. Now what is the situation? Since here debts are also involved. We all know 7 lakh is the net profit. We have to pay interest 1 lakh because 10 lakh was the debt amount. So for debt amount 10 lakhs, I have to pay 10% interest because debt is having a first priority in the organization. because it is a committed. They have an upper hand in the organization. Any profit which the organization is earning, first you have to allocate the amount, you have to take the amount from the profit for repaying your debt instrument, interest on debt instrument, interest on borrowed fund. That is top priority. So 7 lakh minus 1 lakh interest. How 1 lakh has come? 10 lakh was the debt amount, 10% is the interest, so 1 lakh rupees. So net is 6 lakhs. Now in this 6 lakhs, after reducing the interest, I have to calculate the tax also. After reducing the interest, the profit is 6 lakhs. Now from these earnings, we have to reduce 30% tax because slab rate is 30%. So 6 into 30% is 1,80,000. So 6 minus 1,80,000, that is the tax amount, is 4,20,000 is earning after tax. Very clear? Now this earning, now we are dividing it by 4 lakh number of equity shares to calculate earning per share. It is 1.05. So what is the logic you are getting? If we are going for the debt instrument, you are going to have a more value of the firm. You are going to have a more earning per share. See, if the company which was relying only on equity shares, which was the situation 1, the earning per share was 0.98. The moment company has gone for the debt, they have reduced 10 lakhs from equity shares and they have borrowed debt 10 lakhs. So as a result of borrowing, your value of the firm, that is the earning per share, has increased by 1.05 from 1.98. Now let us consider situation number 3. In situation number 3, you have further reduced the equity share capital by another 1 lakh. So it has become now 3 lakh shares, 30 lakhs of share. Now they have increased the debt. From 10 lakh debt, it has come down to 20 lakhs debt. Now profit EBIT will remain the same, 7 lakh. Interest, you have to pay 10%. 20 lakh is now the debt now, because they have reduced the equity share capital by 20 lakhs rupees and they have structured their capital. Instead of equity shares, now they have gone more for debt. So 50 lakhs capital now have reduced to 3 lakhs, and now they have gone for debt capital of 20 lakhs. Now on 20 lakhs, they have to pay interest on, because that is the first priority, 10% I have to pay the interest, that is 2 lakhs. 7 lakh minus 2 lakh is 5 lakhs, that is earning before tax. On 5 lakhs, I have to pay the tax of 30%, that is 1,50,000. So 5 lakhs minus 1,50,000 is 3,50,000. Now in this 3,50,000, I am dividing it by 3 lakh shares, because you have already reduced. Now from 5 lakh shares, now it has come down to 3 lakh shares, because I have structured my debt. I have gone more from the debt instrument now. I have reduced my equity share capital and I am going for more debt. Because I am going for more debt, my earning per share or the value of capital is increasing. Since now you see, from 3,50,000 you divide it by 3 lakh shares, it is coming to 1.16. So it has moved from 0.98, 1.05, 1.16. If we compare the above table, we can see that in situation 3, equity shareholders get maximum return, followed by situation 2. After 1.16, it is 1.05, and least earning in one situation. Hence, it is a proof that more debt brings more income for the owners in the capital structure. So the more you go for the debt, the more you get the earning per share and the more will be the value of the firm. But if you are increasing the debt, one point is to be noted, you are going to have a risk of insolvency. If the company doesn't come out with a good profit, the company may become insolvent and it can run into a bankruptcy. No doubt, if your debt structure in the entire capital composition is more, you are going to have a more earning per share, as it is evident from the example. You are going to have a more value of firm, as it is being reflected in the situation 3. But one thing is to be kept in mind, the more the organization is going for the debt, the more there is risk factors are involved in case the company is earning at a loss and the company may go into insolvency. So one thing is very clear, more debt means more earning per share, that means more value of the firm. Now, theories of capital structure. Capital structure, there are two broad definitions. One is modern theory and one is traditional theory. We'll understand the modern theory. It's a very critical aspect of this whole chapter. There are three approaches are there. One is net income approach, one is net operating income approach, and one Modigliani and Miller approach. Modigliani-Miller are the two. You can call it as a big thinker, a management thinker. So there's Modigliani and Miller approach, net operating income approach and net income approach, and there is a one traditional approach. So this whole structure, the capital structure, is broken down into the following type of theories. So let us go to one part, that is the net income approach. This approach was suggested by Durand. Durand was again the great financial thinker, Durand, and he was in favor of financial leverage decision. According to him, change in financial leverage would lead to change in the cost of capital. According to him, if you are going to restructure your capital, Durand is of opinion that it is going to change the cost of capital. In short, if the ratio of debt in the capital structure increases, if the ratio of debt instrument in your capital structure increases, the weighted average cost of capital decreases and hence the value of the firm. That means the more you are going to have a debt component into your structure, the weighted average cost of capital will going to increase. But the value of the firm will increase, but weighted average cost of capital is going to decrease. Net income approach is based on the following three important assumptions. For each of the theory, there are assumptions are there. There are no corporate taxes. The cost debt is less than the cost of equity. The use of debt does not change the risk perception of the investors. So these are the three common assumptions which they are highlighted while propounding this net income approach theory. So let us understand. So let us recap. What does this theory talks about? This theory talks about that if any ratio of the debt in the capital structure increases, the weighted average cost of capital is going to decrease and hence the value of the firm. The use of, and because it's based on the use of debt does not change the risk perception of the investor, the cost of debt is less than the cost of equity. So the assumption is the cost of debt is less than the cost of equity. So if you are going to have more of debt in your capital structure, the total weighted average cost of capital is going to fall. So this is the formula for computing your total overall cost of capital in the net income approach. That is, NI approach is the net income approach. So net operating income is earning before interest and tax. It is there. We have to pay interest on debentures on the fixed security, this amount. Then earning available after reducing interest from the net operating income, we know earning available to equity shareholders, because you have to pay first to the debenture shareholders. So we have reduced the interest from net operating income. Then whatever the amount is left is appearing as earning available to equity shareholders. Now equity capitalization rate is given. What is the cost of equity capital? Cost of equity. So market value of the equity will come to know. If the earning available to equity shareholders, if you divide by equity capitalization, we will get the market value of the equity, market value of the debt. If you add these two, we will get the value of the firm. Now this value of the firm we have to divide by EBITDA. EBITDA divided by value of the firm will get the percentage, the overall cost of capital. So we'll take this by way of example. It becomes very clear how this formula has been worked out. Now a company expects a net income of 1 lakh. It has 2,50,000 8% debentures. The company is having an income of 1 lakh and it has a 2,50,000 8% debentures. It's very clear. The equity capitalization rate of company is 10%. That is the cost of equity is 10%. Calculate the value of the firm and the overall capitalization rate according to net income approach, ignoring the income tax. We are not taking account the income tax for this competition. Now second part of the question is, if the debenture dates are increased due to 4 lakhs, what shall be the value of the firm and the overall cost of capital? Now from 2,50,000 debenture capital, if we are going to increase by another 1,50,000, that is 4 lakh rupees, how much we are going to have the value of the firm and the overall capitalization rate? Now if we go to the formula, we have a net operating income of 1 lakh less interest on debenture. Interest on debenture means 2,50,000 multiplied by 8%, that is 2,50,000 multiplied 8% is 20,000 rupees. So whatever the amount left after reducing the interest from net operating income is the amount available for equity shareholders, that is 1 lakh minus 20,000 is 80,000. So 80,000 is the amount which is left after reducing the interest on debenture from the net operating income, because this is a debt instrument. We have to pay on top priority to the debenture holders. It is a commitment which we have to do. Whatever the amount left after reducing the amount to be paid to debenture holders will be distributed among the equity shareholders. So 1 lakh minus 20,000, 80,000 is the earning available to equity shareholders. Now equity capitalization rate or the cost of equity, as we all know, is 10%. So 80,000 divided by 10% is the market value of the equity shares, that is 8 lakh rupees. And as we all know, market value of the debt is 25,000 rupees. 2,50,000 rupees. So these two we are going to add, equity shares as well as the market value of the debentures. So 8 lakh plus 2,50,000 will be 10,50,000 will be total value of the firm. And the overall cost of capital will be EBITDA. 1 lakh is the earning and 10,50,000 is the total value of the firm. So 1 lakh divided by 10,50,000, 9.52% is the total overall cost of capital. This is the total overall cost of capital. That is the EBITDA divided by value of the firm. So how much earning? Because this earning we are going to really distribute. So it is a cost to the organization. So this cost we are going to divide it by the total market value of the shares as well as total market value of the debentures. That is 9.52. Now what will happen if we are going to increase this 2,50,000 to rupees 4 lakhs? We are going to increase of 1,50,000 rupees. You are going to increase your debt structure. The debt part you are going to increase. Now the situation is net operating income is 1 lakh. Now interest you have to pay on 4 lakh rupees. That is 4 lakh multiplied by 8%, 32,000. Now remaining 68,000 is the amount available for equity shareholders. As we all know, capitalization rate is 10%. So 68,000 divided by 10% is 6,80,000 is the cost market value of the equity shares. Now these market value equity shares, we are going to add the market value of the debt. We all know is 4 lakh, 10,80,000. What happens? The overall cost of capital will be 1 lakh divided by 10 lakh is 9.26. As we have seen, we have increased the debt from 9.52 cost of capital, it has come down to 9.26. This is what the Durand has identified in his capital structure theory under net income approach. What is that? If the debt structure, if the debt element in the entire capital structure is increased, the overall cost of capital will going to decrease. That is what it is evident in this working. What has happened? From it has come down to, from 20 lakhs, it has come down to 4 lakhs. From 2,50,000 we have increased the debt from 2,50,000 to 4 lakhs. So as a result of increase in debt, your value of the firm has increased, because from 10,50,000 it has become 10,80,000. Your value of the firm has increased, but at the same time your cost of capital has decreased from 9.52 to 9.26. So this is what it talks about the net income approach. Next theory is net operating income approach, that is NOI. What does it NOI mean? NOI approach is contrary to NI approach. It is just opposite of net income approach. According to NOI approach, capital structure decision does not affect the market value of the organization. According to this approach, the capital structure decision does not affect the market value of the organization. The market value will remain the same. The theory states that any variation in the capital structure will not result in any corresponding variation in the value of the organization and market price of shares along with the overall cost of the capital. So it is not going to have an impact on the value of the firm, but certainly it is going to have an impact on the cost of capital. That is what it is understood from this. It is not going to affect your net value of the organization, but certainly it is going to affect the cost of capital. NI approach is based on the following important assumptions. The overall cost of capital will remain constant. There are no corporate tax, the market capitalization, the value of the firm as a whole. Now let us understand this example. It is calculated by way of this formula, that is EBIT, that is earning before interest and tax divided by KO. KO is overall cost of capital, EBIT is the earning before interest and tax, V is equal to value of the organization. Now let us consider this example. XYZ expects a net operating income of 2 lakhs rupees. It has 8 lakh 6% debentures. The overall capitalization rate is 10%. The overall capitalization, not equity share capital. Overall capitalization rate is 10%. Calculate the value of the firm and the equity capitalization rate according to net operating income approach. Because according to net operating income approach, overall capitalization is not going to change in any capital structuring decision, and the value of the firm is going to same. Now let us calculate what is the value of the firm. If you see, the company has a net operating income of 2 lakhs. Now net operating income 2 lakhs. Overall cost of capital is 10 lakhs. Now the market value of the firm is 2 lakhs divided by cost of equity capital. So this is the market value of the firm, 20 lakhs rupees. Now hence market value of the firm, as we all know, is 20 lakhs. We are reducing market value of debentures, which is already given in the question, that is 8 lakh rupees. Now 12 lakh will be the market value of the equity. Now hence the cost of equity will be 2 lakh. 2 lakh is what? Interest on net operating income minus 48,000 is you have been paying 8%. 6% you have to pay the interest. So from the profit, the first priority is debenture shareholders. So from the 2 lakh, I have reduced 6% into 8 lakh, that is 48,000 divided by market value of the equity. So the market value, so total cost of equity capital comes to 12.67 lakhs. Understood? Because how it has been computed, as we all know, net operating income is 2 lakh. The overall cost of capital is 10%. So 2 lakh divided by 10% will give you the total market value. So total market value is given. We know the debenture amount, that is 8 lakh rupees. So 20 lakhs minus 8 lakhs, 12 lakhs will be the market value of the equity shares. Now this market value of the equity shares already has been now derived. Now we have to calculate the cost of equity. How the cost of equity will calculate? First we have to see what is the total profit was 2 lakh. I have to reduce first debenture which I have to pay to the debenture holders, that is 48,000. Then remaining will be divided by market value of the equity shares to come at 12.67. Now the second question is, if the debenture date is increased to 10 lakhs, from 8 lakh it has come down, the debenture has come to 10 lakhs. What will be the effect on volume of the firm and the equity capitalization rate. Now let us see the situation. You have increased the debenture from 8 lakhs to 10 lakhs. How is going to impact on the value of the firm and the equity capitalization rate? So value of the firm will remain the same, 20 lakhs. That is what the theory talks about. Under net income operating approach, value of firm is not going to change, nor the cost of capital is going to change. So when the market value of the firm is this much, debenture, now we have increased from 8 lakhs to 10 lakhs. So 10 lakhs we have reducing from here. So market value, the equity comes to 10 lakhs. The moment you have increased your debt structure, the cost of capital will be 2 lakh minus 60,000. Why 60,000? Because on 10 lakhs debenture, you have to pay 6% interest, which is coming to 60,000. So divided by market value of the equity shares, which is coming to 14%. So the question is, the moment you have restructured, you have increased your debt, your cost of equity capital has increased from 12.67 to 14%. So this is what it comes about in just a reverse of income approach, net income approach. There's Modigliani and Miller approach. Modigliani and Miller approach states that the financial decision of a firm does not affect the market value of the firm in a perfect capital market. In approach maintains that average cost of capital does not change with the change in debt, weighted equity mix or capital structure of the firm. Modigliani and Miller, it talks about that the average cost of capital is not going to change in whatever the structure of capital mix you are going to take. It is again is based on the three important assumptions. This is a perfect capital market. There are no retained earnings. There are no corporate tax. The investors act rationally. The dividend payout ratio is 100%. The business consists of same level of the business risk. So this is what it company talks about these assumptions. Now it is again not very complicated. We are not again going for these examples. This formula is value of the firm, which is calculated by EBITDA, that is earning before interest and tax, divided by overall cost of capital and the tax element. The T is the tax rate. So once with this, we will come to know the Modigliani-Miller approach. Now planning the capital structure. How we are going to plan the capital structure? That is the most key element in the organization. A company, as we all know, is going for equity shares, is going for debentures, is going for preference shares, is going for bank loan. How we are going to, what factors we are going to consider in planning your capital, making a capital structuring decision. Planning a capital structure is essential for long-term survival of the business, because it is a very long term. You are going to, you have taken the loan from the bank, you are taken the loan from the public as an equity shares, and you are taken the debentures from the public, you are going to pay the interest. So of course your company is going to have a long-term vision for the growth and expansion. You have taken all these sources of finance. So liability side of the balance sheet is prepared using ideal capital structure planning. All these sources of finance appear in the liability side of the balance sheet. This is all coming in the left hand side of the balance sheet. So finance manager keeps a watch over the causes that have an effect on the capital structure and determine which source of fund needs to be chosen. The finance manager here play a very critical role. He determines what composition of the total capital structure I am going to have for equity shares, for debt, for preference shares, for debenture. What will be my ideal combination which will increase the shareholders value, which will increase the profit of the organization, which will increase the value of the firm. So this is what finance manager, he keeps a watch over the causes that have an effect on the capital structure and determine which source of fund needs to be chosen. This is a very complicated task of the finance manager. It is not an easy task to determine the capital structure of the organization. Various pros and cons have to be studied in detail. Various element of risk has to be considered. Various payout of interest, dividend has to be considered. Various external environment has to be considered. The industry norms, The industry pattern has to be considered. Your size of the organization has to be considered. How risk, whether you will to face that risk of taking a big amount of loan, big amount of debt for the organization. So all these critical factors has to be considered by the finance manager while deciding on the ideal capital structure. Importance of capital structure are to reduce the overall risk of the company. Any finance manager will always aim to have a very ideal scenario which will help him to reduce the overall cost of capital. The most basic object of any capital structuring decision is to enhance the value of the firm and to reduce the overall cost of capital. To do adjustment according to business environment, there are a lot of factors which are influencing your business today. Today the business organization is very complex. It is influenced by a lot of factors. There are aggregate of forces, conditions, events which is influencing the decisions of the business organization, which are influencing the decisions of the business managers and the finance manager. So, to adjust according to a business environment, if the government comes out with any new regulations in your capital market, in the financial market, you have to consider the capital structure accordingly. You have to mold, you have to structure, you have to reshape your capital structure considering the environment which you as an organization are operating. Company, suppose today government announces some big tax rate, or the company announces huge increase in the rate of interest of the borrowed loan. It is going to have an impact in your organization. It is going to have impact in the capital structure of the organization. Ideal generation of new source of fund. The finance manager is always on the lookout to see which is the cheaper sources of finance in their organization, so that they can maneuver or they can change the structure to suit or to bring more profitability or to more cost effective sources of finance. So the first objective is to reduce the overall risk of the company. A company is operating on a perpetual basis. The company is always aims, the organization always aims at reducing the risk of the organization. That is the most key element the finance manager has to think about. The composition of capital structure has to be made in such a way it will reduce the overall risk of the company. Whether they should insist for more of debt fund, or they should insist for more of capital fund, equity shares capital fund, or debentures, or preference shares. So all these elements has to be considered by finance manager to ensure that the overall risk the company is facing should get reduced. In case of new business, an organization keeps minimum debt in its capital structure as the rate of return will be less than the rate of interest. This is a very important and critical statement. When the business is new, the profits are not much for the organization. You are not earning a very bumper profit immediately on the starting the organization, because you have to settle down, you have to understand the market, you have to face the competition, you have to face the existing competitor. So lot of factors are there. So in this scenario, you are not earning enough profit. Since you are not earning enough profit, you cannot take loan much from the bank, because your commitment levels will be very high. You have to pay interest and principal on time. Since this payment, this outlay is very much committed, you have to pay whether you are earning profit or loss, you have to pay this amount. So in the initial stage of the business, the strategy, what it is talking about is to reduce the debt and to insist more on equity share capital, because since the profit is less, you are not obligated to pay dividend to your equity shareholders. If you have not earned the profit for the organization for a couple of years, it's no problem. You are not going to declare dividend because the company is in loss. The company is not making substantial profit. But if you are taking a loan from the bank at the initial stage of your operation, if the initial stage of your new business, you may become taking a very big risk, because you have to pay interest on a periodical basis to these banks and to this institution, which you cannot escape. But if you insist for equity share capital during initial phase of your business, you are at a very safe position. That's why it is written, in case of new business, an organization keeps minimum debts in its capital structure as the rate of return will be less than the rate of interest. More debt component means taking high risk of return more than the amount of interest even when there is no profit. Even there is no profit, if you have taken a huge amount of loan from the bank, you are committed to pay the interest and the principal amount on a periodical basis, on a stipulated period time, you have to pay. Whether you are making profit or not, you are obligated, you have to pay the interest to the bank. So it means taking a high risk. More debt component means you are taking a high level of risk in the capital structure decision. The debt has to be paid at its maturity at any cost and interest at a fixed rate. At any cost, you have to pay the debt interest to the bank. You cannot say to the bank, no, I cannot pay interest to you because I have made a loss this year. No. Bank is not involved in any charity work to give you the fund free of interest. They will not they will catch hold of you. They will put pressure on you to put the interest. So you have to pay the interest to the bank. So the crux of the issue is, in case of new setup, in case of new operations, the strategy is to have less of debt fund and more of equity shares, where you are not obligated to pay dividend on profit or loss which you have earned for the organization. If the business is incurring successfully, the organization has a choice to increase the estimated amount of debt. If the company is doing quite well, if the company is making a very good profit, yes, then in your capital structuring decision, you can increase the amount of debt compared to equity, because it will bring good earning per share for the organization. The more the debt, the more the earning per share for the organization. That means more will be the value of the firm. Second is to do adjustment according to the business environment. The organization adjusts its capital structure according to the business environment. As was already told you, the external environment plays a key factor in deciding your capital structure. If the government tomorrow increases the rate of interest, loan interest, by 2-3%, today suppose it is 11%, tomorrow the government decided, the banking system decides, no, from tomorrow onwards we are going to have 15% interest instead of 11%. So this 3% additional interest is going to have an impact on your total overall cost of capital, and is going to impact on the value of the firm. So the organization adjusts its capital structure according to business environment. The finance manager is always on the lookout how to optimize your capital structure considering these external environmental scenarios. There are various external factors like economic, political, natural influencing the functioning of the enterprise. There are so many factors are there. The government may get changed, the capital market scenario may change, the money market may change, the primary market may change, the secondary market may change. All these financial institutions and the capital structure, it may going to impact on the capital structure of the organization. So all these environmental factors like political, social, economical, natural, all these factors influences your business, which are beyond the control of the organization. But a finance manager is always keep a track, always monitor the movement of these scenarios and always try to see how it is going to impact on the capital structure, and it is his duty, it is his responsibility of the finance manager to ensure that he has to optimize the capital structure, so that objective is very clear: to maximize shareholders value, to increase the value of the firm, and to have a maximum profit. These influences may necessitate change in capital structure of the finance. In finance, it is called maneuverability. Maneuverability means any situational factor which is going to have an impact on the capital structure, which finance manager is going to work on changing the structure because of so much of environmental factor. This is called maneuverability. Idea generations of new source of fund. This is third most important planning which a finance manager has to do. Good capital planning of capital structure is required to obtain money from new source. Finance manager may even generate a new idea for getting money from public at a low risk. Here what the company will get involved? The finance manager will always in the lookout for way to ensure that how to source a cheaper source of finance. What he should do to ensure that overall cost of capital is going to reduce the overall cost of capital and to increase the value of the firm. That is what always finance manager are always on the lookout. So these are the three most important critical points which we have understood. That is, first is the to reduce the overall risk of the capital. It's very important to do an adjustment according to the business environment, and idea generations of the new source capital. Idea generation, what we talk about is the finance manager should always look out for the options of financing the organization, the financing of investment, the sources of capital, so that how best way he can optimize the capital structure so that this overall cost of capital is reduced and the value of the firm is to be increased. Designing optimum capital structure. How we are going to design the capital structure is now very important decisions of the finance manager. While designing an optimum capital structure, the following factor has to be considered carefully. What is the one? Profitability. Yes. If the company is earning profit, then only you can go for restructuring of your capital. An optimum capital structure must provide sufficient profit. So the profitability aspect is to be reviewed. If you are having a more profit, then you can go for more of a debt restructuring. You can go for a debt instrument. You can take loan from the bank. If there is no profit, you cannot take much loan because there is a risk of insolvency. You have to pay on a top priority to this banking and the financial institution because you have taken the loan from the bank. So if you are generating enough profit, in that scenario, you can take sufficient debt instrument. You can take loan from the bank because from that profitability, you can pay the interest to the bank. But if there is no profit, you cannot resort to heavy debt funding into your organization. In that scenario, you have to insist for an equity share capital. Liquidity. Along with profitability, the optimum capital structure must allow a firm to pay the fixed financial charges. Hence, the liquidity aspect of the capital structure is also to be tested. You should have sufficient flow of funds in the organization. The cash flow fund, because unless you don't have a very cash flow, it will not, because you have to pay the interest to the bank on a stipulated interest. That cash flow has to be considered. Cash flow doesn't mean that you are having a good amount of revenue, you are having a good cash flow. No. If you are having a good amount of profit, that doesn't mean you are going to have a good amount of fund flow. No. It's totally depend upon what are the status of your receivables from your customer. The goods which you have sold on credit to your customer, how frequently those money are received into your organization. If you are having a good amount of credit period, you will not have any cash with you. So that may affect your payment to the financial institution. So it totally depends upon the credit policy of the organization. If the company is dealing on cash, that means goods sold on cash means goods sold immediately you have received the cash. So liquidity position in this scenario will be very high. So once the liquidity position is good, you are in the position to pay the interest on a timely basis to the bank. But if you are not able to generate cash, in spite of having good profit, then it is going to have an impact on the liquidity position. If your liquidity position is bad, you will not able to pay the interest to the bank. You are not able to pay to the interest to your other stakeholders because you don't have cash with you, in spite of having good profit in the organization. Control. The supplies of debt have no role to play in managing the firm. Banks are not going to play any important role in the organization. It is the shareholders who play an important role. Their representative directors are there on the board to oversee and manage the affairs of the organization. Hence, but equity holders have the right to select management. Equity shareholders have the right, they have the voting right to select the representative into the board. So more debt means less amount of control by supplier of the fund. The more the debt you are having in the organization, that means less interference from the financial institution, because they don't have voting power. They will just given you the fund, you have to pay them the interest on a timely basis. That is what the commitment is there. They are not going to influence your decision. They are not involved in your day-to-day operations and the management decisions. It is the shareholders who are involved, the equity shareholders. The representative directors are there who are on the board. They manages and oversees the finances, the various functions of the organization. So more debt means less amount of control by supplier of the fund. Industry leverage. The firm should be compared with other firms in the industry in terms of profitability and leverage ratio. The amount of financial risk borne by other company must be considered while designing the capital structure. You are into a competition, suppose 7-8 players are there in the market. So your composition of capital structure should synchronize with the capital structure your competitors are having, so that you know what your competitors are having the capital structure. What is the debt component, what is the equity share component, what is the debenture component. As a finance manager of the company, you should know what your competitor is having, what leverage, what financial leverage they are having into their organization. Nature of industry. The management must take into consideration the nature of industry the firm belongs to while designing the optimal capital structure. Whether your company is producing any seasonal product, or the company's products are regular in demand, or they are into some sort of a product which it takes durable goods, or they produce some perishable goods. So all these factors, the nature of industry, the company has to decide the capital structure based on nature of industry. That is the one factor which you need to consider. Maneuverability of fund, that we have already discussed. There should be a wide flexibility in sourcing the fund so that firm can adjust its long-term sources of fund if necessary. There should be a flexibility in your total structuring of the capital composition. You should have debt, you should have mixture of debt, you should have mixture of preference share, you must mixture of equity, you have a mixture of debenture. So all these mixture, and there should be a flexibility. You should be able to move out from one fund and enter into another fund. You may exit debenture, you may enter into equity, you may exit debt, you may enter into preference share. It depends upon the composition, and the whole object of this flexibility is to have increase the value of the firm and to have a less of total weighted average cost of capital. So timing of raising of fund, right timing may allow the firm to obtain funds at least cost. Here the management needs to take a constant vigil on the stock market and government steps towards monetary and fiscal policy, market sentiments and other macroeconomic variables. This is which we are talking about, the external environment which are beyond the control, which are beyond the decisions of the management. So this finance manager has to be continuously in touch with these environmental factors like this monetary and fiscal policy. Fiscal policy means there are all the budget, the government expenditure and the revenue. This is what talks about the fiscal policy. Monetary policy talks about the capital market, money market, financial market and all the shares, debentures and all, whether it means long-term securities and short-term securities are traded. Money market means where short-term securities are traded, like banks and commercial institutions, commercial banks and all. And capital market, it talks about the stock exchanges, underwriting firms, mutual fund institutions. So they are all. So all these policies of the government, these fiscal policy, monetary policies, financial market, what is happening in the stock exchange, what is happening in the debt market, all these factors, our finance manager has to be thorough into that because it is the timing which finance manager has to take. If he delays the decision, your interest may go up. So that is a very critical part. So that's why timing of raising a fund is very critical. And the firm's characteristics, size and credit standing also determine the capital structure of the firm. Credit standing means if the company is new, the company has not earned profit, the credibility of that organization will be low, because no bank will offer you any loan because you have just started 6 months back or 7 months back. Your credibility you are could not able to establish in the market because of the new setup. So in that cases, the firm's characteristics very important. When you have started the firm, what will be the composition? The more it becomes matured over a period of time and the company starts earning a profit, the more optimization the company attains in terms of capital structure. So features, the top 5 features of the capital structure. What are its features? Is flexibility. Means the consideration of flexibility gives the finance manager the ability to alter firm's capital structure with minimum cost and delay if warranted by change environment. So flexible, a finance manager should be able to change the financial structure immediately. So that flexibility should be available. So flexibility is one of the very key characteristics of your capital structuring decision. Your finance manager should be able to move out or may enter into any finance decisions. He may change any composition of the financial decision any time. So that flexibility should be there. So profitability, a sound capital structure should permit the maximum use of leverage at a minimum cost so as to provide better profitability and thus maximizing earning per share. This is what we have talked about. If the company is more profit, then you are in better position to leverage your financial structure. You are in a better position to take more debt. You are in a better position to optimize your cost of capital and to increase the value of the firm. So this profitability is one of the key element, the key feature of the entire capital structure decision. Solvency. Extensive debt threatens the solvency and credit rating of the company. If you are in a new setup, if you have taken an extensive debt, that means the company is going to run amok in terms of risk. Because if the company incurs a loss because of the new setup, you may not able to pay the interest and the principal amount for the debt fund, the loan which you have taken from the bank, you may not able to take up easily because you have not earned sufficient profit. Hence, the debt finance should be only to the extent that it can be serviced fully and also be paid back. If you are in a position to service that loan interest, the committed amount which you are going to pay, then to that extent you can able to take the risk. You cannot take more than this. You could not come into a situation of debt trap which will be leading to insolvency and bankruptcy of the organization. Conservatism. No company should exceed its debt capacity. As already explained that the interest to be paid on debt and the principal sum is also to be paid. That is a debt trap. We should not get into a situation where you are not able to generate a sufficient profit, we are incurring loss and our capital structure is very heavily weighted on debt part. As a result, you may as an organization can run into a bankruptcy situation. Control. The capital structure should not lead to loss of control in the organization. As we have already understood, the control should be on the hand of the management because they have clear roles and responsibilities. The more roles are vested on the shareholders, the more decisions they are going to influence on the organization on their day-to-day functioning. So the most of the companies, they rely heavily on debt because in a debt-driven organization, much of control is lying in the hand of the management of the organization, who know the pulse, who know the operations of the organization very much, rather than the shareholders and the board who are outsiders and they are reviewing on a quarterly basis the performance of the organization. So these 5, that is flexibility, profitability, solvency, conservatism, control, are the most important features of the capital structure. Now let us understand these 2 important definitions in terms of capital structure before we move to a theory of capital mix. Cost of financial distress. Cost of financial distress are the costs associated with the company that is having a difficulty meeting its obligation. That means you are in the debt trap. That is, you are in the financial distress. You are not able to pay the interest and the principal amount to the bank. You are not incurring enough profit to generate sufficient fund for which you are going to finance your investment pattern. You have taken loan from the bank, the company is not incurring any profit, you are going to pay the interest on that. So consistently the scenario gets repeated, you are into the debt trap, or in other words, you are in the financial distress. So cost of financial distress, the cost associated with the company that is having difficult meeting its obligation. So cost of financial distress include the following: opportunity cost of not making optimal decision. On the wrong time, you have taken a wrong decision of taking a loan from the bank rather than going for equity shares or the preference shareholders. As we have already discussed, if the organization is new, if the organization, as we all know, when a new organization set up, it's very difficult to earn a very bumper profit or reasonable amount of profit for the organization, because it takes time. They have to face the competition, they have to establish credibility in the market. So the profit earning capacity of the firm at the initial stage of the business is not very high. So in that situation, if we have taken a very wrong decision of financing through debt, then you are taking a big risk. Hence, opportunity cost of not making optimal decision, inability to negotiate long-term supply contract. That means when you are starting a new business, you are into a lot of contracts with your vendors. So when you are entering into contracts with the vendors for suppose supply of machinery, you are going to produce one goods for which you need a machinery. So for the purchase of machinery, you have agreed to pay them everything by 3 months. But the company has not generated revenue. How you are going to pay? From where you are going to generate that sources of fund of paying those vendors within 3 months? It is not possible. So you have to increase the long-term supply of contracts. All these contracts at the initial stage have to be 1 year, 2 years. After 1 year, you are going to make the payment. So inability to negotiate, because you need a fund to pay after 2 months, 3 months. Loss of customers. You may lose the customer because you have not been able to sell the goods into the market at the initial stage. You are not able to establish that credibility. Your products are yet to get strong hold into the market, into the perception in the mind of the customer. So in that situation, you may lose the customers. The expected cost of financial distress increases as relative use of debt financial increases. So the financial distress is directly related to the amount of debt which you have taken for financing. If you have taken the more debt, that means the risk associated with the debt is also increasing, like bankruptcy, insolvency and all. Now, concept of agency cost. What is agency cost? Agency costs are those costs associated with separation of owners and management. As we all know that any organization, we have a separation of ownership and the management. The concept of separate entity, there is ownership and management, there is a separate entity in the organization, that's all we know. So agency costs are the costs associated with separation of owners and the management. They are monitoring cost, bonding cost. What happens if you are going for a equity shares? For 100%, a company has insisted, has gone for the equity shares as a sources of finance. What will happen? The shareholders will have on their board a representative board of directors who will oversee the management, who will review the performance of the organization on a quarterly basis, and with close monitoring will be done. So because of this, you are not going to have, as a management person, you are not going to have much control on the overall functioning of the organization, because it will be driven by these board members who have been appointed by the shareholders. So this monitoring cost is one of the element is there in agency cost. Then bonding cost is taking on risk project could benefit shareholders more, while taking more risk means higher chance that debt bondholders will default. Sometimes the companies take a very high risk of investments by taking loan from the bank, but that is very riskier. Because why they are taking a high risk? Because they wanted to provide a huge return to their shareholders. They are expecting that because of this investment, the company is going to have a super bumper profit. But at the same time, banks becomes very careful. Your debentures, your debt vendors, they become very careful, because they know that if the project doesn't click, or if this investment which the company is pursuing very aggressively, if it doesn't click, then they will be at the fault. That means they will not receive the fund nor the interest and all. Just to appease the stakeholder, on aggressive basis they have invested a huge amount in this project, but the company may not receive the amount, the bank may not receive the amount. So this is the bonding cost. The better the corporate governance, the lower the agency cost. The more, it's a very important statement. Corporate governance is, it is a system by which a company is directed and controlled. A good corporate governance, as we all seen in the Infosys or Tata Group, they are driven by a very strong corporate governance. That means it is well directed and controlled from the board, from the employee, from the various stakeholders. The whole organization runs in a very coordinated effort and a very well channelized with clear-cut directions and policies. So those type of organizations, we call it as a good corporate governance. Now, the better the corporate governance, the lower will be the agency cost. Because if the company is driven by a good system, values, policies, guidelines, procedures, what will happen? Then the board will not be very much interested into day-to-day affairs of the organization. So the monitoring cost will be reduced. They don't have to worry about the company is doing well. The people who are managing the affairs of the organizations, they are managing the company very well without much of hitches or without much of losses or without much of problems and complications. Those companies are generally termed as a good corporate governance. So the higher the use of debt relative to equity, the greater the monitoring of the firm, and therefore the lower the cost of equity. So the moment you are into the debt part more, that means the banks and all, they are going to monitor your affairs of the organization in terms of your performance, in terms of your profitability, because they have financed your firm. They are basically interested to know their principal, their interest, they should return it back. Otherwise, it may create a problem for the organization also. It may create for future lending also. Bank may refuse future lendings in such scenario. So trade-off theory of capital structure, this is very most important element in the entire capital structure decision. When we call up trade-off theory, means the trade-off theory of capital structure refers to the idea that a company chooses how much debt finance and how much equity finance to use by balancing the cost and benefit. So here the finance manager do a trade-off. How much debt I should go, how much loss I am going to incur. How much equity I should go, how much benefit I am going to have. How much cost I am going to incur for each debt financing and for equity financing. This is a very critical decision, very vital decision finance manager has to take in day-to-day operations of the finance function. He should be able to know what are the cost and benefit for each sources of finance for in each whatever is constituting your capital structure. Trade-off theory of capital structure basically entails offsetting the cost of debt against the benefit of debt. So what are the costs and the risk associated with the debt, what are the benefit I am going to arrive from the debt, that is the trade-off. The trade-off theory of capital structure discusses the various corporate finance choices that a corporation experiences. So any company, by making out the decisions for which composition of finance I am going to have, either I am going to have more of debt, or I am going to have more of equity, or I am going to have more of preference share, or I am going to have more of debentures. So each element in the capital structure are being weighed in terms of benefit and cost. That is what it is called as a trade-off. So benefit and cost of each sources of finance, to understand their risk, their benefits, their cost involved, then it is known as a trade-off. The trade-off theory of capital structure primarily deals with two concepts: cost of financing distress and agency cost. This is what we have discussed. The trade-off theory of capital structure primarily deals with the two concepts, that is cost of financial distress and the agency cost. Financial distress, what we have understood, the cost of debt which is going amok. That means we are not going to have a control. We are not able to sustain
that loan which you have taken, because we are committed to pay the interest, we are not in the position to pay the interest because of we have incurred the loss. So this is a financial distress, and agency cost is the monitoring cost, because the people who are sitting on the shareholders on the board, they are continuously reviewing, and there are cost and the time involved. An important purpose of the trade-off theory of capital structure is to explain the fact corporations usually finance partly with debt and partly with equity. So trade-off means partly with debt and partly with equity, partly with the plus and minus of the equity share capital, and partly with the plus and minus of the debt capital. It states that there is an advantage to financing with the debt, the tax benefit of the debt, and there is a cost of financing with the debt. The cost of financial distress, including bankruptcy cost of debt and non-bankruptcy cost, that is staff leaving, suppliers demanding disadvantaged payment terms, etc. So it takes the advantage of financing with the debt. Why it is advantageous? Because the interest which you have paid on this borrowed fund are deductible for tax computation. It is shown as a debit side in your profit and loss account. Hence, net profit, net income is arrived at after reducing your interest from the gross profit. So gross profit minus interest and taxes will give you the net income. So always there is an advantage of financing with the debt, because you are getting a tax advantage. The marginal benefit of further increase in a debt declines as debt increases. As you borrow the more debt, that means you are going to have a marginal efficiency. That means while the marginal cost increases, so the firm that is optimizing the overall value will focus on the trade-off. As we have seen in the previous example, the more you are having the debt, the more you will have the value of the firm, and you are going to achieve the efficiency of the organization. That's why it is talking about the marginal benefit of further increase in the debt. As we have seen, from 2 lakh it has increased to 3 lakh, the debt, and the equity shares have been reduced. As a result, your earning per share or the value of the firm has increased. So the marginal benefit of further increase in debt declines as debt increases, while the marginal cost increases, so that the firm that is optimizing its overall value will focus on the trade-off by choosing how much debt and the equity to use for financing. Pecking order theory. This is another important critical theory in relation to your trade-off theory. Pecking order theory talks about, its theory states that the company should prefer to finance itself first internally, correct, through retained earning. The pecking order theory states that company should prefer to finance itself first internally through retained earning. That is the first, this is a very primitive way the organization used to work. If the company is having enough profit, that means the company from the profit only will be able to finance their investment, and that all the investment decision is to based on retained earning, because today most of the companies are not having enough retained earnings. That's why they have to rely on external source of fund, like borrowing from the banks, like borrowing from the equity, like the issue of shares, equity of preference share, issue of debentures. Now all these instruments are there in the market, but in the earlier, which pecking order theory talks about, if the company is having enough profit, then first you should rely on your internal fund. If this source of financing is unavailable, that means if retained earning is unavailable, a company should then finance itself through debt. If there is no sufficient profit, retained earning is not there. Retained earning is what? After distributing the dividend to the shareholders, whatever amount is left is the residual profit or the retained earning. Now, if retained earning is not there, then the company is asking that, as per this pecking order theory, you have to go to the bank for the debt, or you have to issue the debenture. If this source of financing is unavailable, a company should then finance itself through debt. Finally, and as a last resort, a company should finance itself through the issuing of equity shares. This is very important. If the company even is not in the position to take the debt, then it should take as a final decision to go for equity share. Finally, as a last resort, a company should finance itself through the issuing of equity, new equity. This pecking order is important because it signals to the public how the company is performing. If a company finances through internally, it means it is strong. That is good. If the company is having a strong profit, they are not relying on bank loan, they are not relying on equity shares, they have enough cash profit, they have enough profit revenue to finance their investment decisions. That means the company is doing very strong because they are not relying on anything, instrument, there is no other thing, they are not relying on bank, they are not relying on debentures, they don't want to go to public, initial public offer, shares. They are only relying on their own profit. Hence, the company looks upon them as a shareholder, they look upon this company as a very strong organization. If a company finances itself through debt, it is a signal the management is confident the company can meet its monthly obligations. Because you have taken the loan from the bank, you have to going to pay the interest, so the company meets its monthly obligation. If you have taken the loan, so any investor, before investing in that company, they see the capital structure of the organization. If they are having a more debt, that means yes, the company is having enough capacity to pay off its interest and principal on time. That's why the company has taken, and the company is doing a good amount of profit. The EPS, the earning per share is also good. The value of the firm is also good. So the company, so the investors will critically evaluate the balance sheets and the profit and loss accounts, and to ensure whether the company is confident can meet its monthly obligations. If the company finances itself through issuing new stock, that means through issuing of shares, it is normally a negative signal, as the company thinks its stock is overvalued and it seeks to make money prior to its share price falling. That means company is always relying on the fund from the outsiders. They don't have their own capacity to generate fund from inside. They don't have capacity to generate fund from the banks, from the debentures, but they are relying on the public like us. So they have lost the confidence, particularly in this scenario, because the company few years will not give you any profit, any dividend to the shareholders. So that is a very critical factor while taking the decision. So what we have understood is the capital structure theory. Let us recap for 10 minutes what we have learned today to have a better grip on the subject. As we all know, capital structure is a composition of equity shares and the preference shares, and how the capital structure, it is always appearing on the liability side of the balance sheet. So this review of fund which is appearing on the liability side of the balance sheet, which is being reviewed by the finance manager, is known as a capital structure. So that a capital structure refers to the relationship between the various long-term sources such as equity shares, preferential capital and a debt capital. Financial leverage is the extent to which a business firm employ borrowed or money fund. That is, what will be the composition, whether it will be only equity share or it will be equity shares plus debenture shares or preference shareholders or loan from the bank. So what will be the composition? It totally depends upon the capital structure, and the finance manager critically evaluates the capital composition to ensure that the overall cost of capital is reduced and to enhance the value of the firm. So as we have seen, there are only two cheaper sources of finance: interest payment as a tax deductible expenses, because it is reduced from the gross profit to arrive at a net income, hence it is a tax deductible expenses. We should know the objective of doing the capital structuring. The objective of financial decision is to maximize the shareholders' wealth, increase the value of the firm. This is a very critical aspect of any financial decision. The objective of any financial decision is to maximize the wealth and shareholders' wealth and to increase the value of the firm. Then we have introduced very important thing is changing the financial mix means changing the level of debt, and change in the level of debt can impact the interest payable by that firm. Correct? Because you are committed to pay that amount to the company. You are committed. So you are at a very big risk, because you can go anytime at insolvency or bankruptcy if the company is not making a profit and you have taken a very huge amount of loan, because you are committed to pay. So you cannot escape. So decrease in interest would increase the net income and thereby the EPS. And it is general belief that increasing in the earning per share lead to increase in the value of the firm. The more the earning per share, the more this is the value of the firm. And the more will be if the earning per share will be high, the market price of the share will also high. That is the very most important thing. If the earning per share of the organization is high, the market value of the share will also be very high. So financial leverage is a useful tool to increase value, but at the same time nothing comes without a cost, because the debt funding always involves a big amount of risk. The risk means risk of getting to insolvency and interest part, because you have to committed to pay the interest on the loan which you have taken, the debenture interest which you have to pay to the stakeholders. So all these elements you have to consider, and if you are not in a position to pay that interest, there is a risk of insolvency or the bankruptcy. So what we have understood, if your composition of the debt instrument in your capital structure is high, then the value of the firm or the earning per share of the firm will be high. So discussion of financial leverage has an obvious objection of finding an optimal capital structure leading to maximization of the value of the firm. So value of the firm, the whole object of capital structuring is to reduce the cost of capital and to increase the value of the firm. So these are the factors, these are return, cost, risk, control, flexible capacity is to be considered while deciding on the capital structure, very important consideration. Then we have understood the capital structure assumptions, that there are no corporate taxes. This assumption is removed later. Later on we came to know in the working the capital structure, tax computation was involved in the capital structuring. The dividend payout ratio is 100%. Whatever the amount which you have been remained as a profit, it has been distributed among all the shareholders. The total assets are given and do not change. Your investment decisions are not changing. Whatever the loan which you have secured, whatever the funding which you have obtained for a specific purpose, it will be utilized exclusively for the specific purpose. You are not going to change it. Then the total financing will remain the constant. The whole total financing will remain the constant. Whatever the structure, like 5 crores you have taken, 1 crore of equity, 2 crores of preference, 2 crores of debentures. So you can sell one, you can inject one into a capital structure, you can increase your equity share capital, you can decrease your debt capital, but within this 5 crore only you can play around. You cannot increase from 5 lakhs to 5 crores to 7 crores or 5 crore to 8 crore. Within that 5 crores, if you are managing the fund, with managing the capital structure, that is acceptable. The operating profits are not expected to grow, that is the EBIT, that is the earning before interest and tax is not going to expected to grow. All investors assume to have the same or subjective probability distribution of future expected EBIT for a given firm. Each and every shareholder are having some expectation, and that expectation has to be considered in your capital structuring decision, assuming that this expectation is not going to increase. Whatever the expectation they are having is going to be retained with them. Suppose the company has been paying debenture on interest for 8% for consistently for 3 years. On 4th year, they should not expect the company will pay 12%. So it is 8% means the company will pay 8% only. So the whole capital structuring assumption is based on that. The dividend, the EBIT that is earning, all the investors will have the same expectation for the dividend. Perpetual life of the firm, it is assumed that business will have a continuously perpetual life. And business risk is constant. Whatever the business risk has been identified at the time of capital structuring, it remains constant, it is not going to change. So as we all know, the classification of capital structure, either we'll have equity shares only, or we'll have equity shares and preference shares, or the equity shares and debentures, or the combination of all the three, that is equity shares, preference shares and debentures. So these scenarios we will consider as while calculating the earning per share. This is very critical. We have understood the 3 situations, 1, 2 and 3. In 1 there was only equity share capital. In 2 we have a mix and match of both equity and debt capital, and in 3rd situation with equity capital and when enhanced debt equity capital. That is, it has from 10 lakhs debt equity, it has come to 20 lakhs, and we have computed the scenario, all the scenario, and we have found that the more we have the debt, the more we have the earning per share, and the more we will have the value of capital. So if we compare the above table, we can see that in situation 3, this is the situation, equity shareholders get maximum return followed by 2 situations and least earning in 1 situation. Because in 1 situation there was no debt, hence the earning per share was very less. The moment they have migrated into a debt fund, your earning per share has increased. Hence it is a proof that more debt brings more income for owners in the capital structure. Then we have understood the 3 most critical theory, modern theory, net income approach, net operating income approach, Modigliani-Miller approach. So net income approach, Durand, which we have spoken according to him, change in financial leverage would lead to change in the cost of capital. In short, if the ratio of the debt in the capital structure increases, the weighted average cost of capital decreases and hence the value of the firm with some assumptions. And this is the template for calculating the net income approach. First, we have a net income, then we are reducing the interest on debenture, because it's the first priority. We have to make the payment to the interest to the debenture holder first. So what is the amount left after reducing the debentures from the income will be available for equity shareholders. Then we have cost of equity. So from the amount which is left for equity shareholder, we have to divide with cost of equity to arrive at a market value of the equity. So if you add the market value of the equity and the market value of the debt, we come to the value of the firm. So this total earning divided by the value of the firm will get the cost of equity, overall cost of capital. Then with the help of example, we have understood the things very clearly. Again, in the scenario where we have increased the debt composition and found out that the overall cost of capital has reduced. Then net operating income, again it is just opposite of the net income, which we have understood in great detail. We have worked it out with examples for considering the 2 situations. Then Modigliani-Miller approach, formula for Modigliani-Miller approach. Then the capital structure, the planning for capital structure, this is also very critical, where we have understood the 3 most important planning which we have to do is to reduce the overall risk of the capital. This is the most important risk which finance manager has to be considered while evaluating the capital structuring decision. Then second is to do adjustment according to business environment. As we have learned, there are a lot of factors, external environmental factors influencing the business decision. So financial manager is no exception to it. He has to consider all the external factors which are influencing the capital structural decision, like any fiscal policy, any budget policy, any capital market policy, any money market policy, any introduction of new instrument in the market. So all this is going to have an impact on the capital structure decision, which finance manager has to consider. Then ideal generation of new source of fund, any new source of fund in the existing capital structure which will bring down to the overall capital cost of capital has to be considered by finance manager. This good capital planning of capital structure is required to obtain money from new source. Finance manager may even generate a new idea for getting money from public at a very new, correct. This is very important. Then designing optimal capital structure. So while designing an optimal capital structure, the following factor has to be considered very carefully. What are those? One is profitability. If the company is having adequate profit, then only the company will be able to take more debt. If the company, as we have discussed, in a new stage of capital structure, new state of production, or new stage of operations, it is very risky for the organization to take the debt. Similarly, the liquidity. The company is having enough profit doesn't mean the company is having a liquid position. So the liquidity position means you should have sufficient fund in your account so that you should be able to pay out your committed external payments like your debenture holders, your bank loan interest, your principal amount loan interest. So liquidity aspect has to be considered by generating a capital structure. Then control. As we all know, when the company is taking loan, there are less controls from the bank compared to the one which is equity share capital, because equity share capital are putting the shareholders into the board and electing board of directors who will oversee the affairs of the management on a quarterly basis, and that also going to impact on the capital structure. Then industry leverage, what our counterpart, what our competitors are involved, how they are framing their capital structure decision should play an important role in deciding what my company's capital structure is, in what way I am better in capital structuring compared to my counterpart, or in what way, what extra they are doing, or how they are optimizing the capital structuring. That should give me an input to evaluate and to assess my own capital structuring decision. Then nature of industry, the management must take into account the nature of industry firms belong to while designing the optimal capital structure. Whether we are producing durable goods, or whether we are into some seasonal nature of the product, or whether we are into long gestation period, any product which pertains to long gestation period. So all these factors also creates an impact on the capital structuring decision. Then maneuverability of the fund, the company should able to flexibly move out from one fund and should enter into a fund within the least amount of time to reap the maximum benefit of the changes. Then timing of the decision, right timing may allow the firm to obtain fund at least cost. Here the management needs to take a constant vigil on the stock market and government steps toward monetary and fiscal policy, market sentiments and other macroeconomic variables. Lot of factors, as we all know, are influencing the decisions, where finance manager has to play a very key role in deciding the monetary and fiscal policies, and it will determine his capital structuring decision. Then the fund's characteristic, size and credit standing also determines the capital structure of the fund. If the company is small, has newly entered into the market, they should not resort to taking the debt fund from the bank. That will create a issue for them. So features, there are top 5 appropriate capital structure features which we are going to catch up. One is the flexibility, profitability, solvency, conservation, control. So flexibility means finance managers at any point of time should able to move out from one fund and should able to enter fund without additional cost, with the object of enhancing shareholders value, with the object of increasing value of the firm, and with the object of reducing the overall cost of capital. Profitability, a sound capital structure should permit the maximum use of leverage at a minimum cost so as to provide better profitability and thus maximizing earning per share. So this is also very important. The more the profitable is there, the companies can resort to more of debt fund compared to equity fund. Then solvency, extensive debt threatens the solvency and credit rating of the company. If the company has been defaulting the interest payment and the principal to the bank, then they are into the radar of the various rating agency. They may not able to rate the company on a proper scale in terms of credit worthiness if we are defaulting the payment of interest to the bank. So it's very critical decision that our organization has to take, that we should not end up in defaulting the money to be paid to the outlay, to be paid to the bank. Then conservatism, no company should exceed its debt capacity. As already explained, that the interest to be paid on debt and the principal sum is also need to be paid. So this is the commitment which you have to pay. So if the company is earning good profit, then only we are able to make the commitment. So this concept of conservatism has to be kept in mind. Sufficient amount of provision has to be made for payment of this type of transaction, because company cannot afford to have a reminder from the bank, or because any sort of default, because it may lower our credit agency in the market. Control, the capital structure should not lead to loss of control in the company. Again, this control aspect we have already done. Then there is the cost of financial distresses. The financial distresses, the company which are not able to meet its obligations. There is opportunity cost of not making an optimal decision, inability to negotiate to long-term supply contracts, loss of customers. These are the very critical financial distresses which happen. Then we came across the agency cost, or the cost associated with separation of owners and management. There are monitoring costs and the bonding costs. As we all know, the shareholders are appointed by the board to oversee the affairs of the organization, and there are costs involved because with board members you have to pay the sitting fees, and a lot of elements and costs and other miscellaneous expenses has to incur. So these are the agency costs which we have to consider while deciding on theory of capital structure. So the better the corporate governance, the lower the agency cost. Very clear, if the company is well managed, if the company is well driven by values, with good beliefs, with proper systems, controls, guidelines, then the company being termed as a good corporate governance. Corporate governance means it's a system by which a company is directed and controlled. So the higher the use of debt relation to the greater with the monitoring of the, and therefore better with the lower cost of equity. Trade-off. The trade-off theory of capital structure refers to the idea that a company chooses how much debt and how much equity finance to balance its cost and benefit. This is also very critical. trade-off, we have come across theory of balancing it out between equity and a debt capital. For each sources of finance, what are the pros and the cons? That has to be considered. So trade-off theory can discuss the various corporate finance choices that a corporation experiences.